Check, check, testing, testing. Here we go. All right, guys. So you might have heard, not heard, you might have wondered. Maybe you've never wondered. I've never wondered. I never thought about it when I get a job and I'm wondering why I'm filling out this application. I'm thinking they just want my information. They just want to know. Want to know who I am, where I live, if I am who I say I am. Honestly, I don't even really think. I just assume this is just what's right and proper. Someone has a business, offer me a job. They need my information. It's really why though, right? Like why? Why do they need my information? And then what do I get in return from them, you know? So what do I get from them? So we assume the world has perfect information. It doesn't. Nobody has the perfect information. When you go try to buy a car, you're not sure. You're just hoping. You're hoping that it's ideal. You're hoping that they're honest. Oh, it's a good car, man. It's never been in an accident before. When you get insurance, you're hoping that they're going to cover you, and the insurance company's hoping that, if I cover you, that it's like, okay, you're healthy, you're not going to get die tomorrow, and life insurance already. Like, damn, man, person barely bought their fucking life insurance and they're already dead. Now I got to pay out their family. That's not a winning business strategy. So perfect information. Information is very important. Perfect information doesn't exist. So there's ways in which an employer deals with that imperfect information. There's ways that the person seeking employment, or the consumer, deals with that imperfect information. And there's ways that financial and capital markets deal with this imperfect information. We're going to talk about that. Something I learned in my 2-year university. What's also important, they teach this at the 2-year university level, the community university level. The This is in an economics course called microeconomics, the micro level of the economy. So so in order to deal with imperfect information, the fact that you're not going to get all the knowledge and facts and everything that pertains to that specific thing, you're not going to have it all. So that you need a way to ensure yourself. So in order to deal with imperfect information in the goods and services market, the consumer must rely on the reputation of the seller, a warranty, a guarantee, and the ability to access the legal system in order to enforce a contract with the supplier, in order to force a lemon law. What a lemon law is a legal protection for consumers after buying a product that's flawed. If you go buy a used car and that shit breaks down, you have a lemon law. I can bring it back and I can get my money back and make an exchange, get another one. It's called a lemon law. So the consumer is protected. One, the reputation of the seller, a warranty, which is a promise to fix or replace an item with a given time, a guarantee, promise to refund with a given amount of time, the ability to access the legal system in order to enforce a contract, enforce a lemon law, you know. Now, in the labor markets, what protects the employer? There you go. The application, the resume, the interview process, recommendations from existing workers. Maybe in your business, you require them to have a license, have a degree, take a test. Also, that probation period is a key process for the employer to be able to protect themselves. There's a 90-day trial period of at-will employment. So at-will employment are when employers are not required to have a just cause for termination. They're not required to have a reason for firing you. And when it comes to the financial and capital markets, the banks, the loaners, people who loan money, how they deal with imperfect information. Remember, the idea is the fact that they don't have all the information. They have to trust another person and their word for it. So, how these lenders, these banks, these loan companies, how they deal with this imperfect information. Obviously, you have to fill out an application for a loan so they can check your background and your history. You have a co-signer. A co-signer is when another person assumes the risk for a borrower. You also have collateral, giving them something, giving them one of your assets that if you don't pay back, they have the right to keep that asset, to seize that asset if you fail to repay your loan. So the idea of insurance. Insurance companies, they manage risk. They manage any possible adverse outcome. Any possible adverse outcome. How they do this, they create a risk pool or risk groups. So insurance companies manage risk by creating risk pools, which are groups of people who share similar risks. The larger the risk pool, the more risk is spread, so the insurance system is more efficient with lower costs. So the more insured people in your risk pool, the lower the cost can be. More people take on that risk. More people, there's more people in that risk pool, so the costs are lower. And there is a more complete coverage. There's more comprehensive coverage. So insurance companies manage risk by creating risk pools, which are groups of people who share similar risks. All right, so let's just use the auto insurance for an example. So the people within this pool pay a premium, which is a regular payment in order to be covered by the insurance. They pay a monthly fee to be insured. Remember, let's say it's a huge auto insurance company. It's a lot of money going in. It's a lot of money going in. So remember, there's a fundamental law of insurance: money in and money out. That money in is a premium. That money out is when this person within this risk pool makes a claim that they think should be covered by this insurance company. When an accident occurs, they make a claim. That's the fundamental law of insurance. Money came in by your premium, money comes out by you making a claim and the insurance company paying that claim. But how did they come up with these percentages? Insurance companies use actuarial analysis to manage risk. And when they take on that risk, they call it underwriting. So an actuarial analysis is the use of statistical models to manage financial uncertainty. So the actuarial analysis is the use of statistical models to manage financial uncertainty by making educated predictions about future events. So an actuary guesses the odds of bad things happening. That's why like your house burns down, you die, car insurance, life insurance, workman's comp. So they do these odds and percentages. 0%, nothing's gonna happen. 100%, which equals, it goes from a 0 to a 1. It's percentages, but it's between 0 and 1. A 1 is 100% something's gonna happen. A 0 is nothing will ever happen. A 0.5 is 5%. Chance of happening 50-50. So the way the insurance companies look at it, something there's never a zero chance of something never happening. Remember, this is chance. This is a prediction. Unless you just stay at home and you don't do anything, maybe that's a zero. But if you go walk, if you take the bus, you ride a bike, and there's cars by you. Remember, this is an example of car insurance. It's your odds of being involved in a car accident are some number bigger than zero. So, for example, of the actuarial analysis, they gather data, right? Right now they're worried about, they're trying to get a percentage chance. They're trying to predict what's the percentage every mile driven of there being an accident. So they do mathematics, they do some division. So let's use the year 2022. I guess there was 5 million accidents in 2022. And then they get the miles driven in 2022. They divide the accidents by the miles driven. So 5 million accidents divided by 3 trillion miles driven in the United States. And they get a number. It's 0.000017. So that's every mile driven, there's a 0.000017% chance of an accident. Then they get deaths from car accidents. That's like the worst case scenario. In 2022, I guess it was 40,000 car accidents in the year 2022. They divide that again by 3 trillion miles driven, and they get a really small number. But then they get like an average of miles driven per year. So they turn that, let's go back up to the accidents per mile. It's 0.00017% accidents per mile driven. Very small number. Then they get an annual of miles driven per driver. They get a mean number, and it's 10,000 miles. So they get a percentage. Remember, 10,000 has 5 numbers, so the dot from the 1 moves over 5 times. So from that 0.00017%, and they move that over 5 times, it becomes to be 1.7%, 1.7% accidents per 10,000 miles driven. So every 10,000 miles driven, there's nearly a 2% chance of an accident. So that's their baseline. That's the baseline they're going to use. Their baseline will be 1.7%. Every 10,000 miles, someone will get into an accident. And then, so now they're looking at factors involved. They're going to look at factors of each driver, right? Your factors include your age, your car type, the claim history, if you ever had any claims before. Look at your history of driving, coverage history, credit score, driving experience, driving record, gender, location, marital status, miles driven, if you have tattoos, many other things. They don't do it off of race, they don't do it off of color of skin. They do it off of character and personality, though. Is it fair? Probably not. But it may be logical and empirically sound to say that younger males as a group are at higher risk than older women. Is it discrimination? Probably. However, discrimination is legal in almost every situation, whether it involves employment, housing, or business services. But there are some protected categories. Discrimination on the membership protected categories is illegal, such as like race and religion. So let's see right here. Look, a 54-year-old woman, she drives safe. She has an economic car. She drives under the average of 7,000 miles per year. No previous speeding tickets, no previous accidents. So remember, there's a baseline, 1.7%. The odds of getting into an accident this year are probably lower than 1.7. She doesn't drive as much. She doesn't drive a lot. Her history, they're making predictions. These insurance companies are using actuarial analysis to make predictions. She's an older woman. She has an economic car. She doesn't drive a lot. No previous speeding tickets. No previous accidents. She has a record of safe driving. She drives less than 10,000 miles a year. So her premium, her monthly payment is going to be less. Compare her to a 19-year-old young man. He drives a fast car, expensive. He averages 24,000 miles per year, has 12 speeding tickets, and 4 accidents previous. The odds of him getting into an accident are higher than that 1.7% baseline. His record's bad. He drives a lot. His premium's going to be higher. So besides the actuarial analysis, besides the actuarial analysis method, the specifics of the claims process in an insurance policy affect the price of premiums. So another way that these companies kind of cover themselves with this imperfect information, they get a deductible, the amount a policyholder must cover before any insurance payment or amount deducted from a claim payment. The higher the deductible, the lower the premium. Lower the deductible, the higher the premium. Makes sense, right? So there's two different ways. There's an annual deductible. So let's say you have a $3,000 claim. You have to pay that $1,000. The insurance will cover the rest. But remember, if you already paid that a couple months later, so they're kind of saying, well, you pay up first and then we'll cover the rest. You have a deductible of $1,000. Let's say in January you get into an accident, it costs $3,000. $1,000 comes out of my pocket, they pay $2,000. If I get in an accident in June again, they'll cover the whole thing. But there's also a $1,000 per occurrence deductible, per occurrence. In January, I get into an accident, same thing. I pay my deductible $1,000, they pay the rest. With a $3,000 claim, it's just $2,000. They comes from them, $1,000 from me, makes it $3,000. But then in June again, another claim for $1,500. It's per occurrence. $1,000 comes out of my pocket, $500. They make up the difference. So another method is called a copayment or a copay, where the policyholder pays a fee for each use of a claim. Where the policyholder pays a fee for each use of a claim-generating service. Copays are common in medical insurance policies. Higher copay policies, lower premium. Lower copay, higher premium. Now there's something else. Remember, we don't. This is because of imperfect information. There's something called an asymmetric information, when one side has more info than the other side. That's asymmetric information, going one way. When one side has more info than the other. Your shady salesman, car salesman, he knows the car's a piece of shit. He don't give a fuck. He's not going to give you all the information, right? That's why as a consumer, you have the reputation of that used car company, or that salesman, the used car company, that business, the reputation of that business. You have a warranty. You have what was it again? Warranty. Was it guarantee? I think a guarantee, right? Yeah, you have a. Where was it at? Yeah, warranty, guarantee, and the ability to go to court. So that's a risk you take. Asymmetric information. So that's the reason why these companies do collect. No. So insurance companies collect large amounts of data to not only conduct actuarial analysis, but also to deal with asymmetry of information. So most of the time, it's in the insurance companies that have to deal with this, because someone could say, "Oh, I've never been in an accident." Let's say you get life insurance. The guy could just say, I never smoked before," because he doesn't smoke now, but maybe he smoked when he was 20. Now he's 50. So they use a large amounts of data to conduct actuarial analysis. But not only that, but also to deal with information only where one party has more information than the other, which in this case it will be me, because I'm saying, hey, I'm a good driver. I don't drink and drive sometimes, or I'm not going to tell you these things, right? These companies know that. There's other things they do too. Okay, it's called a moral hazard. There's also something called a moral hazard. So the fact that maybe one party has more information than the other So the asymmetry of information and risk sharing sometimes creates a moral hazard. So a moral hazard is when a party has little or no incentive to guard against risk because most or all of the costs will be borne by another party. Remember, that's why these insurance companies, the idea like, well, I have insurance, I could drive fast, and they'll pay for it, they'll pay for it. An example was in 2008 with the market crash where the banks were going under, right? Well, they were able to take such a big risk because they were so, them going under was such, would have caused such a major effect that the banks, let me read it. During the 2008 financial crisis, the US federal government bailed out large banks who were close to collapse. So the government bailed out these large banks who were close to collapse. Political leaders claimed these important financial institutions were too big to fail, meaning the downfall of such banks would have such devastating consequences to the economy that the government must use taxpayer money to cover the bank's losses. Remember, when the government bailed them out, that's your money. As a result, a moral hazard was created. A moral hazard was created. If large banks know the government won't, if large banks know that the government won't let them fail, they can rationally engage in even more risky behavior. If the risks are successful, they reap big rewards. If the risks are not, the costs are paid by the taxpayers, not the risk-taking banks. That creates a moral hazard. So how these insurance companies defend these things, they use things like deductibles and copays to reduce the impact of moral hazards to ensure costs of risks are always shared. Very brief, very insightful. Minus all the mathematics that's involved and all the paperwork and how these businesses are actually ran. It's just very insightful. Very practical as well. Very insightful. Moral hazards, actuarial analysis, asymmetrical information, that this is all due to imperfect information. That's why they need your info as a consumer, as the employer, as a money lender. And so that's some other. I'm gonna do another video, but this, I guess I'll make this called the theory of imperfect information and what insurance companies consider.